All right, folks. As I always like to start off these streams, I like to say, please give me a second. I want to make sure that we're live on all the various platforms. This will be a good conversation. I've actually gotten to know Laks for the last, I don't know, I want to say year and a half or so. Very thoughtful research. I think many of you will find it interesting, the kind of big picture topics we'll talk about as far as markets, Trump, but also individual ideas that she's honing in on alongside her team at Unicus Research. If any of you want to engage during this roughly 45-minute conversation, doesn't matter if you're watching on X, LinkedIn, YouTube, I can see your comments, I can see your posts, which means if you do have a question, ask it on whatever platform you're watching. I'll bring it up. Let's make this as interactive as possible. As always, this will be an edited podcast under Lead Lag Live on all of your favorite platforms. Apple, YouTube, Spotify, top 5% most downloaded podcasts out there. Please help me keep that momentum going, given that, believe it or not, this is not my day job. So with all that said, my name is Michael Gayed, publisher of the Lead Lag Report. Join me for roughly 45 minutes is Laks Ganapathi of Unicus Research. Laks, you're somewhat of a newcomer, I think, on the podcast scene, but introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Um, Hi everyone, this is Lux, and that's my cat in the back. Sorry about that. We started at Unicus around in 2020, and we provide independent research to the institutional investors, whether it's short research or long. And we have been known for short side. We also do some long ideas along the way. We approach the research differently. We do deep dive, channel checks, speaking to ex-employees, doing surveys, so on and so forth, in addition to the fundamental and quantitative analysis. So I have known Michael for a while, and has been source of mentor, and we are going on and off for a while. And he asked if we could go live and discuss about the current political environment and how it will impact the market, and which pretty much nobody knows, but at least we can get an idea of which sector to stay away from, which sector to get involved in. There are a lot of opportunities for growth stocks at this point, and so we will just go over some of them. And also, I wanted to touch base on the lag effect, and I think Michael has been saying that for quite a while, and we strongly believe in that. Whether it's interest rate hike or cut, there's always a lag, and what we are seeing right now in the economy is not as a point in time. So we will touch base, and I'm sure Michael will have a few more points to add to it. Michael?
So you mentioned you're kind of known for the short side. As you know, shorting is extraordinarily challenging and difficult. Can also be the most rewarding, right? Because
Yeah.
you're actually identifying something which fundamentally might be broken. Why focus on that? I mean, a lot of research tends to be long only because markets tend to go up over time, so the research wants to align to that. What is it about shorting and that kind of research that appeals to you?
One of the main things is the market is very welcoming, so to speak, on companies that want to go public. There are a lot of successful companies, and Michael, you're absolutely right. Long investing, growth investing is there. You can buy a stock, for instance, whether it's Apple and or whether it's Walmart, you can buy it and you can sleep well at night. Like you said, short selling is very rewarding. It's also risky if not done in a proper way. What I mean by that is the reason why I am personally attracted to short selling is there are a lot of cult stocks. There are a lot of stocks that come to the market to benefit from the fad. A classic example of is the subsidies. In 2020, every single corporation started investing so much money into environmental and social governance. And we have been strongly against that since the day one. Um, we also saw a lot of subsidies by the previous administration to thrown into companies that are not by itself scalable or sustainable in the long term. For instance, SolarEdge is one such company. We recommended SolarEdge as a short at around $329. And before we did recommend the stock as a short to our clients, we did a 2 to 3 months worth of work before we recommended it. The way we did is, Michael, is that uh, short selling involves a lot of hard work, and in a sense that, and every short seller, from Hindenburg to everyone who are doing an excellent job will know that because you have to be thorough in what you are doing. Otherwise, because the downside risk for short selling is unlimited, and you don't want that. Um, so back to Solar Edge, we spoke with more than hundreds of solar installers nationwide. And we reached out to them through emails, we reached out to them over the phone to understand the pulse of the market. Because according to the company, the failure rate of the solar edge products are, just to clarify, they make inverters for the solar panels. So the company is an Israeli company, and it claims that their failure rate is less than 1.1%. We wanted to make sure that is accurate because so we reached out to all the installers and surveyed it. What we realized after 2 months of that hands-on research is that the failure rate of SolarEdge products was more than 30 to 40%, and it was not disclosed to the management, did not disclose that to the shareholders or the consumers. And the consumers of SolarEdge are not the regular mom and pop, they are the distributors. After speaking with the distributors and installers, we realized that no one wants to use the product. Then we shifted our focus into the fundamental analysis, and that's when we published the report. So the stock is right now trading below 25, and our target price was 50. So we have been doing this with respect to electric vehicles, with respect to solar sector, and now OEMs in the auto sector. So Michael, like you said, it's short selling is not for everybody. It's a very, very labor intensive work that goes into it.
There's certain characteristics of industries that make the companies in those industries more apt to be either fraudulent or something that would make it a more attractive short. I mean, solar subsidies in general, that to me makes sense as far as a kind of a focus area. But what other commonalities do you tend to find?
The management. Management can be, the goal of the management is to provide maximum benefit for the shareholders and manufacture quality products. One of the components we look at is the management. Sometimes, for instance, a while ago, we recommended, um, 6, 7 years ago, we recommended an ultra low cost carrier airline. At that point, there was a CEO, and I don't want to mention the name of the company at this point because the stock 6 years ago was 180. And currently, it's around 50. So the CEO at that point, the word is he talked to his employers and said, I don't care if the engine falls out of our airplane. And trust me, the engine used to fall out of the company's airplane, and it's a miracle how no accident happened. And FAA is complicit in this. So the CEO walked in and said, I don't care if the engine dropped out of the airplane. You got to keep the plane flying. If you can't, if the maintenance is expensive, don't bother doing it. So this kind of management is a clear shot that the company is going to go down the drain. So that is one of the key aspects that we look into. Currently, one of the companies we are looking in, the management is such a mess. We have never seen a mismanaged company like this. It's Stellantis, it's an European company. Everybody knows it. The CEO is just such a reckless CEO we have ever seen. And he has been driving the company to the ground. And as we speak, Stellantis has been laying off employees in the United States. So Chrysler, for those of you who are listening, Chrysler, Dodge, Jeep, Ram, um, Chrysler, Dodge, Jeep, and Ram are American companies. They're iconic brands, and it's a legacy brand. And a while ago, it was sold to a European company called Stellantis. Stellantis is nothing but a big roll up, and lately. Um, During COVID shifted so many sectors, and dealerships and OEMs are one of them. During COVID, stimulus happened. Everybody got extra money in their pocket. People who used to be subprime, they got the stimulus and they paid off their credit cards, and their quality of credit went up. So they were lured by more credit by the banks, and OEMs like Stellantis and dealerships who carry their product started to increase the price of the products. For instance, I don't know if anybody knows this, um, the price of a Jeep or the price of Dodge is anywhere from $70,000 to close to $100,000. You do not pay $100,000 for a new car. I don't care how great it is, because it's a depreciating asset. So the cost went up, and the consumers started buying the cars that they cannot afford. Banks started giving away money, so everybody is knee deep on debt, and on the asset value of the car, the has a negative equity, so which means they cannot easily turn it in. And what happened is the management realized its mistake, and up until a few months ago, they did not want to reduce the price of the car, Michael. And what's going to happen? What happened was nobody wants to buy. And this is a chain reaction. So you have the OEMs, then you have the dealers, then you have the banks that provides loans to the dealers. So without going in detail, right? Now they are laying off people, thousands and thousands of people in the United States. And this is going to, the stock is already down more than 40% at least this year. So this is one of the most mismanaged company. And here is the answer to your question. The management, the board members, and the CEO are refusing to let the CEO go because the CEO's contract is expiring 2026. So he's not willing to step down, and the company is still going down the drain. And companies like this are a perfect story for shorting. I don't know if that answers your
Yeah,
question.
no, that's good. And which then, and obviously it's easier to short when you're actually in a bear market, right? Because if you're in a bull market, it doesn't matter how crappy a company is, it's going to get flows to some extent. So the odds are against you. So when you think about managing risk when it comes to specific short ideas that you're highlighting that you might be shorting yourself, how do you think about the macro environment you're doing that under? Because again, if that saying, "A rising tide lifts all boats," makes it hard to
Yeah.
see a company that you really believe should be, much lower, get there.
That's a classic example. What the couple of companies comes to mind, and one of them is Carvana. I know a lot of fund managers who used to be short Carvana, who are still short Carvana, and we never touched Carvana since 2023. And you were absolutely right. No, you can't say that. Hey, I short it in a bear market, and I'm up. Uh, on the return side, but in actually shorting in a bull market is whether it's a bull or a bear market, your thesis needs to be strong, and that um, one of the recommendations that we made not so good call, because no one can hit every single idea that they claim recommend. So one of the ideas we got terribly wrong and is Reddit. Reddit has never made any money, and we try to stay away from companies that are very retail driven. For instance, Reddit, Carvana, right? So Reddit, when it became public, we recommended as a short. It was 60, no, 30 or 40. And right now the stock is way up north of 100. Right, I don't know what is it today, but that was not one of our best moments, to put it lightly. And when the stock starts rallying, the first earnings call after they became public, we realized that they using AI strategies to boost the traffic and boost the organic revenue. And we just told the clients, you know what, we made a mistake and please cover. So um, we wrote a cover on Reddit, and that is a classic example of it does not matter whether your research is right. Um, if the stock is a freight train, no matter whether it's a fraud or not, you better stay away from it. Otherwise, it will run you over. And Reddit is a classic example. And we wrote a cover and we just stepped away from it. Another example is Carvana. Carvana is we recommended it as a short around March or April in 2022 when the stock was around 83. Our thesis at that time was Carvana is enticing the customers to swap the car with them and buy the cars from them. However, we traced a lot of multiple lawsuits that uh, um, blamed Carvana for not giving the title for the cars the consumer bought. So the consumer paid the money, they bought the car, but they didn't have the title to prove that it's their car. So that was such a messy scenario. So we recommended it at that point, um, citing the lawsuit, citing why this is a problem. And at one point, Department of Justice, if my memory serves right, was behind it. So the stock went from 83 in March of 2022 to all the way to $4 in December 2022. And usually there it's a bear trap, like you I have heard you call multiple times, which is true. The bear trap is where you see the stock at 4 and it came from all the way down from 83, and you're like, hopefully they will go for bankrupt. Let me keep press the short. And as tempting as it was, we wrote a cover, and January, we were asked by several client of ours at that time that are we recommending it as a short, and their answer was no, because around first quarter of 2023 we sensed a lot of people shifting to Carvana as a long, from momentum investors to black box. And their thesis was in the long term, in the long term, companies like Carvana will offer an online marketplace for buying and selling and swapping cars. And eventually that will put the dealerships, aka the middlemen, out of business. This is talking about, Michael, extremely long term. And if you recall, Amazon has come up with, and I think it's tied up with partnership with Honda or Hyundai to sell the cars online. So companies like Carvana started to gain attention as an online marketplace in terms of convenience, um, and in terms of reduced prices. So surcharge for dealerships, surcharge, multiple surcharges. So sans that, you will have a online facility where you can go select a car, buy it, and drive it. So a lot of momentum investors starts to come in, and we realize we do not want to touch Carvana. And Carvana is at, I don't know what's the price point today, but it's been rallying since then. And our notion on Carvana is we do not want to touch it as a short. And I do believe some of them, some there are short sellers and fund managers who are still short Carvana. Um, there might be a pullback, but we do not want to stay and learn it the good way or the hard way. So those are the bad traps that short sellers want to stay away from. It's not like we are 100% on it. We got screwed on Reddit, and we accept it. But I don't know if that answers your question, but that's where.
Let's talk about tariffs for a moment, because it seems like the talking point that's out there is this is more about a negotiating tactic for Trump than anything else. It's not something he's going to go crazy on. Let's say that Trump does enact a number of new tariffs. What areas do you think are going to be problem areas for the marketplace that maybe you'd want to turn your more negative bear short hat on to?
When it comes to this, is completely, I'm apolitical. I try to state that way. And having said that as a disclaimer, Trump is, you never know what he's going to say. And market, in my humble opinion, hates uncertainty. It wants to have a consistent, this is what's going to happen. This is what's going to happen at a format meeting. This is what's going to, Sharpov is going to say. Market likes certain amount of certainty. And when it comes to Trump, no one knows what he's going to say. He will say, he currently is saying he's going to put tariffs on China. And he came out and said that he's very disappointed with Stellantis. And if Stellantis were to move its production and manufacturing facility to Mexico, he's going to impose, I believe he said 20 or 30% tariff. I'm not sure, but he's going to impose tariffs on Stellantis on if they choose to take their manufacturing to Mexico from the US. Now, it gets political and kind of murky because the UAW, Sean, explicitly supported Kamala Harris. So I don't know how that is going to go because uh, he can say he's going to apply tariffs and then try to save the jobs when Stellantis is completely moving the facility before Trump's election. And second, when it comes to tariffs, the one thing we are 90% sure is that Biden administration's Inflation Reduction Act 2022 will one can expect that it will be repealed by Trump on day one, and which means companies like First Solar, where it gets nearly 80% of its revenue from government subsidies, will be killed. So those are the angle that one can look at. Um, when it comes to the sector that will be impacted, whether by tariff or whether by job creation, is going to be wind energy, solar energy, anything related to ESG will be dismantled. So anything coming from China, if he applies tariffs and if he actually gets it done, you will see slowly inflation to rise up. And that is going to be a problem. So we don't know how he's going to do this balancing act between imposing tariff and trying to keep the inflation down. That is for us to say, but that should be interesting.
How do you think a Trump administration would impact different
I'm sorry.
sectors? How do you think the Trump administration policies would impact different sectors? Meaning, should we expect that tech will continue to be an outperformer the next 4 years? Maybe energy, and what should be the laggards?
Oil, oil will go up, and obviously some Trump is in favor of crypto, so that's already going up. Um, our play in terms of long is there are two or three companies that are Trump pure play. One is GEO. It's a private prison. They reported a couple of days ago, and the stock has been rallying since the news came out that Trump won the election. And GEO has contracts or expected to have more contracts with the government agency, especially with ICE, and also CXW. Again, these two are longs that we are currently looking into. We usually do not talk about stocks that we are focusing on the short side. So since it's long side, these are the two stocks will have a huge impact. And anything gun manufacturing, or sellers like Strom Ruger, we expect the stocks to go through the roof during the period of Trump administration. Uh, with respect to the lags, solar is one, wind is another one. Anything foreign will have a huge impact on the Trump administration and not in a good way. So we are looking into recommending stocks in Europe, and it's Trump is focused on protecting American interests. So anything that is not protecting the American interest will be the laggards.
You mentioned crypto, Bitcoin's obviously done uh, quite well in other altcoins. Um, where could there be disappointment there? I mean, I think everyone's now thinking that Trump's going to follow through on this whole idea of a strategic Bitcoin reserve. What practically happens? Is it just a function more of deregulation in the crypto space? I mean, how do you think through sort of the investment thesis there?
Well, to be completely candid, I do not follow crypto. My good friend David Towell follows crypto, and he has his finance daily every morning at 8 o'clock. You can follow him. On that for anything related to crypto. I do not want to claim that I know about that space when I have a lot of catching up to do. Let's put it that way. When it comes to deregulation, what we are seeing is there's going to be a deregulation in the banking sector, and that is good and bad in certain way, and it all boils down to Michael, how much of what Trump said is he going to follow through, and that's all it comes down to. Because one of the one of the key things that he shared is, I'm sorry, I have to look into my notes because he said he's going to cap the credit card fees at 10%. Now, this will not happen for so many reasons because um, under the National Bank Act, banks are required to abide only by certain interest rate limits, and the Military Lending Act has put 36% on many lending products to the active military duty personnel. And there is also a specific cap within the range of in the 20s that are allowed to charge the credit card interest. But having said that, Trump coming out and saying we are going to cap credit card fees, credit card interest at 10% is a huge commitment. And we think that he cannot see that through because of two reasons. One, if he somehow gets that passed, he's going to he's going to remove the credit availability indirectly from the very people who wanted him in the office. So the entire majority of Trump supporters, right? They are, some of them are in Wall Street and some of them are in Main Street. And the people who are supporting cannot afford, right? Everyday things. The inflation is going through the roof. So they are using credit cards. So the credit card debt currently is about 1.14 trillion. At this point, it's not about politics, Michael. If he gets the 10% cap passed, the banks will refuse to provide credit to the subprime consumers. And that is going to be a huge problem. And that is concerning for us. And again, we don't know whether it's just a rhetoric or whether he will actually see it through. But of all the policies, this one really stands out, as well as tariffs.
Everyone's very bulled up, right? Post election. Um, do you think this is all justified, or is this a setup for disappointment?
When it comes to the market, since 2020, whatever is happening, there is a lag. For rough estimate, right? For every interest rate hike to trickle down to everybody, it takes roughly 12 to 18 months. And for every interest rate cut, it takes the same amount of time to have an actual impact to regular people, to trickle down uh, the the layers, right? So from 2020, you have stimulus, and then you have drastic interest rate hikes. It hasn't caught up, in my humble opinion. It hasn't caught up 100%. And now we started to cut. He started to cut 50 basis points, and now he cut another 25 basis points, and the market is rallying. And it's not sustainable, right? Our debt is going through the roof. Consumers are tapped out. There is liquidity there in the market, but consumers who are um, reliant on their paychecks, they are swapping their credit cards, trying to get through their month. And in addition to that, you have a whole new unaccounted, under the radar credit that's available to the subprime consumers, which is buy now, pay later, and nobody wants to touch it. We call the credit score companies, and we spoke with the senior personnel in those companies a while ago, and they do not factor buy now pay later in deciding consumers credit score. So there are a lot of liquidity going around, and at the same time consumers don't have the liquidity to get through their daily um, daily life. And this includes from car insurance, home insurance, to car payments. Car payments are $800 per month. And the loan amount that the banks have been giving is um, 80-month installment. There were a case where 120-month installments. So they would never pay that car, and they cannot swap the car because of the amount of negative equity that's in the car. So Michael, I don't know where we are going to go, right? Or for all we know, the market can scream bullish for the next 6 months. But the way the market has been behaving, all I can say is it's unsustainable. It is absolutely not sustainable. How the banks are holding up their stock prices, how some companies are still um, using debt to pay dividends so they can hold the stocks is absolutely unsustainable. Um, in our humble opinion, what's going to happen is that we will see a lot of volatility between now and the first quarter of 2025, and then we will get a little bit of color where the economy is actually heading to.
We're pretty much towards the end of the time period here. Lots for those who want to track more of your thoughts, more of your work, get access to Unicus research. Where would you point them to?
You can go to our website, unicusresearch.com. Or if you wanted to just see what we focus on in general, you can send us an email. It is my name, Lux, at unicusresearch.com. We would be happy to answer any questions you might have.
Everybody, please make sure you follow Lux. I will see you all in the next episode of Lead Lag Live. And hopefully, if you are a short seller, you consider some of her work. So thank you, Lux. Appreciate it.
Thank you so much.